terrific Tuesday, fantastic Tuesday, something. And then you have to remind me to put that in as a poll in Fearless. We need a better name for Tuesday training. So guys, why is real estate a better investment than any other investment out there? Why does it have a power that no other investment has, and an ability to build wealth faster than any other investment consistently? Yes, can Bitcoin or stocks or whatever, can it bring us wealth? Absolutely, for sure. But on a consistent, long-term, reliable basis, why is it that real estate works so well for so many, that it's the number one way that people become millionaires? Why is that? Number one reason, hands down, number one reason, and if you can get this down pat, you can explain it to your joint venture partners and to your...
That's the key in all of this, really.
Yeah.
The key in this is if you can explain real estate investment concepts, if you can explain the power of real estate versus, potential partners investing in another product, investing in stocks, maybe mutual funds or some other product at their bank
Forex,
or whatever.
Yeah.
If you can explain clearly why real estate benefits them and why they can get a better return, you become the expert. And that's really the key to this. So speaking intelligently like an expert is really what we're trying to get across here. This is a really basic real estate investment concept, but it's not basic when it comes to explaining it sometimes. Sometimes we explain these things and we get too complicated and we get too confusing and we just confuse people. So today we're going to try to explain it in a simple, clear manner.
So, and when you're talking to people that don't have a background in real estate and don't fully understand it, you have to simplify things down to the basics. So excuse us if you're a little bit, into real estate and you understand these concepts. But it's not about understanding them yourself. It's about being able to clearly explain them. Mm-hmm. So we encourage you to do exactly what we're going to do today. Break it down, sit there and talk yourself through. Talk in a mirror, write it out on paper, pretend as if you're talking to someone and practice it out loud so that you can get down pat. How do I explain this to somebody who doesn't have a basis in real estate? Because if you can do that, you'll be amazed at how many light bulbs will go on for those partners that you're trying to raise capital from. You're looking for money for your real estate deals. You're looking for partners. You're looking for whatever. It's a fantastic way to simply explain why the power that real estate has, why it has it.
Yeah. So today we're really going to focus on one concept, and that concept is leverage. So thanks for everyone for saying hi. I got to duck down here and increase the size of our comments. Okay. Oh, you can see them on there?
I can just do it on my phone.
Okay.
Right? Yeah.
Okay. So let me do that here too, just so that we have it. And there we go. Now we can see everybody's comments. Okay. Good. Perfect.
All I see is one, and it says Marie. I know there's many more than that, but and I can't see that far anyway. So
thanks for saying hi as you're coming on. That's awesome. We love that. So let us know where you're from, and let us know if anything we say today is kind of a new light bulb in your mind, because you know what? Quite frankly, as I was going through this today, there were a couple of light bulbs that went on in my mind, and I've taught this concept before. We've talked about this concept many times, and yet even when I started to run through the numbers, I was like, wow.
This is amazing.
Yeah, this is actually quite cool.
When you stop and look at things, you're like, right, I forgot. This is one of the reasons we first got into real estate. This was one of the first things that we went, for me anyways.
It was our aha moment, really.
Absolutely, for me. When I learned it at this free seminar where they then sold you into this crazy program that was out of the States and talking about title and all this stuff that we couldn't do in Canada anyway, but I was sitting there and they taught me this principle and I was like, who wouldn't do this? How can we not do this? This makes so much sense. It immediately 5X's your investment. Immediately. And it's tried and true. Oh, we've got our mics. Can you guys hear us?
They're way down here.
What is with us?
Oh, they're right here.
Oh no, and it's plugged in even.
Yeah.
Oh, hilarious.
So let's just put our mics on.
Oh my goodness.
There you go.
Could you guys hear us before? I don't know if you can hear us.
All right, let's put our mics on. Talk about running mad last minute.
From Port Moody. Awesome.
Okay.
From London.
Maybe you can hear us a little better now.
It's really cool. Yeah, maybe that's going to be a little bit better. So who's ready to hear about something that you can do? Teach simply, simple, easy to your joint venture partners, get in your head really fixed so that you can start explaining to others why they need to partner with you, why they need to give you their funding to buy more real estate. Who's ready to hear it? Heck yeah. Use them, heck yeah.
Lori May says, where's the scenic background view? Well, we're doing a whiteboard today, Lori May. So we're going to try to explain this concept in a simple way. And that's kind of the whole point. We haven't done a whiteboard video in quite a while. So we thought we would do that today and try to simplify this concept. Because if we can explain these things in a simplified manner to somebody, I remember somebody, I won't say who it was. I remember somebody saying to me, never mind, I won't say who it was, said to me several years ago, why would I invest in real estate? I'm getting 6% every single year on my mutual funds. Why would I invest in real estate?
It was.
Real estate's not going up 6%. And I thought to myself, real estate's not going up 6%. That's true. Real estate at the time was staying flat. He's probably doing pretty good at 6%. What do I say to that? I didn't really have much to say. Now, this was 15 years ago, and we didn't have the experience that we have now. But
is his 6% comparable is a 30% in real estate.
Yeah.
And that's what he was missing. That's what we were missing. That's what we didn't know how to explain. But
so
that's what
numbers, we're going to run through some numbers, and we're going to show the difference. And if you have questions as we go through the numbers, as we go through the examples, I want you to ask the questions. I want you to drill us. I want you think a potential partner might say to you, you ask it now. And so if all your questions are answered, this can be a very simple concept to try to explain to somebody else.
Okay, so what is leverage? We're talking about leverage today. What is leverage? When you use a lever, what you're doing is you're trying to conserve effort, you're trying to conserve energy, you're trying to use something, anything. So if you think about like prying a nail out from under, using the back of a hammer, which those two-prong things, that's a lever. So you end up using that to conserve your energy, to maximize your results. Little bit of input, but a lot of output. That's what leverage is. Now let's apply that to real estate. What does that become? That becomes we're putting in as little amount of money as we can, but we want it to return to us as maximum amount as we can. Okay, so that's leverage. You can think of a lever or a hammer or whatever it is to think about how does that translate to real estate.
Okay, good.
Yeah.
So
I'm just gonna move this.
you're going to move the camera.
Yeah.
Okay. I'll wait for it. No. Okay.
No, go ahead.
Okay, so guys, let's start with an example, okay? So when we're explaining things to somebody, if we can use an example of some sort, an illustration of some sort, what that does is it just makes the concept easier to understand. So I'm going to run through an example here, and we will see exactly what leverage can do for us in real estate. And then I know you'll have some questions. So as we go through this, throw them in the feed. So where's my pencil or
Right
my
here.
pen? Okay.
Your pencil?
All right.
You want your
So
pencil.
we have two examples we're going to run through, okay? So we have one guy, and his name is Sean, okay? So let's, oops, sorry. So we have Sean, all right? And he's an investor, okay? And then we have also...
But Sean, like, he's a really, really good guy.
Mm-hmm.
Super great. He's from the East Coast. He's a wonderful guy. Pretty funny. But he's not that savvy of an investor, like he's great, but he might. And then we're going to invest. Karen actually.
Okay.
Karen
So
is going to invest the better way. So Karen is pretty savvy. She knows what she's doing. She thinks ahead. She's got her stuff together. So Karen is going to be investing the more savvy way, and Sean's just going to invest, the normal Sean kind of way. So that's the scenario we're going to run through.
Okay, so scenario number one, they both have the same amount of money. And now we're talking real estate here, okay? So we're going to talk about a little bit bigger numbers. We're going to buy a piece of real estate, an average piece of real estate across Canada is somewhere between $400,000 and $600,000. So let's just pick $500,000, okay? So they both have $500K. Now, let me know if you guys can see this on the whiteboard, okay? I want to make sure that you're able to see this. So they both have $500,000 to invest.
We can, but it's way high. But oh well, whatever. Who cares?
Okay.
Okay, we each have $500,000 to invest. So, cash.
Yes.
Okay,
Okay. So now, Sean, and this is the question we get all the
I'm gonna
time.
move out of the way.
Yeah. So if we have $500,000 to invest, what are we going to do with that? Now, if I bought one house, so let's say Sean goes out and he buys a good, beautiful little rental property, okay? It's got a nice little chimney and there's smoke coming out and the snow is falling. Okay, so it's a nice little rental property, all right? Now, this is a cash flowing property. He rents this one for $3,000 a month, okay? $500,000. After his expenses, he cash flows on it definitely because he doesn't have a mortgage on that. He buys it free and clear. Okay, somebody puts $500,000 down on a property free and clear. Okay, then Karen also does the same thing. Karen buys the exact same property next door. Okay, it's also beautiful. All right, got a chimney and it's a gorgeous little property, but Karen does something a little bit different. Okay, Karen uses leverage. Now, this is the point that we're trying to get across here. All right, so Sean used his $500K, bought the property free and clear.
Okay, just wait. I just have to make one comment. So I see someone says, who has $500K to start? Right?
Yes.
None of us have $500K to start.
Yes.
For sure. However, the principle of this, we're going to break it down into
Yes.
real life after, but the principle of it.
Don't get stuck on the number right now.
Yeah.
Okay,
It's
so
best dealt with
so
here.
what
You'll
we're
see.
doing is just showing how real estate gives us leverage when
Yeah.
we're investing, okay? And that's the point that we're trying to get across. So don't focus on the 500K right now. We will get to that in a little bit, okay? So Karen also has that same 500K to invest. But what she does is she goes out and puts 100K down, all right? And she gets a $400,000 mortgage, okay? Now, there's a difference here between the two. Sean put his $500,000 on the house, bought it free and clear with no mortgage. Karen put 20% down, which is the standard here in North America. It's the standard here in Canada. If you put 20% down, you have to put 20% down if it's a rental property. You can put less if it's your personal residence, but if it's a rental property, you have to put a minimum of 25% down. Now, some people put 25, 30, 35% down, but 20% down is kind of the industry standard. So Karen's doing a great job of leverage here, okay? So she puts 20% down, which is $100,000. Now, in real estate, we want the market to go up, right? That's kind of the whole point of buying a piece of real estate. We want to get three things from it. We want to get cash flow on a monthly basis. We want to get mortgage pay down, and I'm going to show you in a minute why that's important. And we want the market, hopefully we're buying in a market that's going to go up in value, okay? So now over the last 50 years in North America, all over Canada and the United States, on average, real estate has gone up just over 5% per year. Now remember that. It's gone up just over 5% per year. Now does that mean that every year it goes up 5%? Absolutely not. Some years it's gone up 2%. Some years it's gone up 9%. I remember back in 2007, 2006, it was going up 20% in a month here in our area. But then sometimes, some years, it goes negative as well. So some years it can go -5 or -10%. But the point is over a 50-year period, on average, in a long time span, it goes up roughly over 5%. But what we're going to do is just use a little bit more conservative a number, and we're going to say that Sean and Karen both bought in a good market. They both bought in a market that is going to go up 4% in a year, okay? So it's going to appreciate by 4%. So now let's take Sean's example. Sean paid $500K, it goes up 4%. What's the value of that property after 1 year? The value of that property going up 4% is $520,000, okay? So what did Sean make? Sean, in this case, made $20,000 profit.
That's great.
It went up. It's good.
Yeah.
He made a 4% return on his money, which isn't bad at all. Okay? So let's now compare that and show the power of leverage when we look at Karen. Karen bought the same property for $500,000, but because she only put $100,000 down and she got a $400,000 mortgage from the bank, and now her property's in the same neighborhood, remember, same property, and it goes up to $520,000 as well. She also makes a $20,000 profit. But what's the difference? In this case, in Sean's case, he's making a 4% return on his money,
ROI.
or return on investment. In Karen's case, because she only put $100,000 down, she's making a 20% return on her money. Okay, so that is really where it all starts. That's the concept of where all of this real estate investment stuff starts, is the less money we put down, if we make the same return, 20,000, but we put less down, then our return on investment goes up significantly. Okay? So we're going to pause there for a second. And I want to know whether any of you have any questions. I want to know, what are you thinking? Does this make sense? Is this confusing?
I'm just going to throw this out. This is ROI, and the
Yep.
difference is the fact that some of it was leveraged and she's using
Exactly.
some of the bank's money.
Exactly.
Yeah.
Other people's money. We talk about that all the time. OPM, or other people's money. When we use other people's money to invest and we make a profit on it, then that increases our return on investment, right? And in this case, other people is the bank, because we are making a return on the bank's money. The bank is giving us money, and yes, we pay interest on it, but we're making more money than the interest we have to pay. Okay? So that's really where we can make more money in real estate. That's why real estate is so powerful, because any other stock, okay, or any other investment.
So do it.
So let's say I had 500,000, same thing, and I invested in a stock. I invested in a mutual fund. Any of those types of things. And it goes up, let's say the stock goes up 10%. I make $50,000 in that case. Goes up 10%. What is my ROI? 10%. Is it as good ROI as real estate? Absolutely not. It's not even close. It's half. So a stock would have to go up 10% just to equal this example. Because you're using all of your own money. You're not using someone else's money. You're not using the power of leverage. Okay?
So why do we need to know this? For one, it's a huge reason why real estate becomes the number one investment vehicle for most people, because you're putting in a little bit, again, that leverage. Think of that lever that you're trying to pop a nail out of a piece of wood with. You know, that lever, you're putting minimal effort for maximum result. You're putting little down for a maximum return. And the way you do that is by using the bank's money, because your return comes on the full amount, the full $500,000 investment, whereas your return here only comes on the money that you actually put down. Mm-hmm. So here we're making an ROI on money from the bank that we didn't even use. We didn't have to come up with. We just borrowed it. So the power of leverage, why is it important? Because for one, it reconfirms for us that, you know, it's a stable, smart investment where the leverage is already maximizing our results for us, even when we're not, or even when the market isn't. However, the other beauty of this is the fact that you can tell your joint venture partners, you can explain to them really simply, and you can do it in a number of different ways, but you can do it by, you know, comparing a stock. If you put, you know, $50,000 into stocks, you know, and it went up 10%, what would you get? You'd get $5,000. If you put $50,000 into real estate as a down payment, what would you get? That would be 20% of a, what? Help me out there. $300,000 investment?
Yeah.
No, through like a $260,000 investment. That goes up 10%. You get $26,000 back. So, you know, the same money, but you're getting way more money back for the little that you're putting in. So again, maximizing your results. So when you're able to show that to people that you're talking to that are interested in real estate but don't necessarily know the details of it or understand why it's powerful, yeah, it's a huge benefit to you to be able to explain this.
Now, here's the key to all of this, okay? So we've kind of just simply touched the power of leverage. But now there's so much more to this, okay? So Sean spent all his money on this house for $500,000. Goes up, he made 20 grand, he made a 4% ROI. Good for Sean. Karen, in this case, made a 20% return on investment, but how much of her 500,000 did she invest? She only invested 100,000, okay? So she still has 400,000 more to invest. Now, Karen can go and buy house number 2, house number 3, house number 4, and house number 5, assuming they're all priced at the same amount.
For the same money
For the same money
that she could have bought one cash.
as Sean bought one. Now, she puts $100,000 down, 100 on each of these, plus her 100 here. She now owns 5 houses. She owns $2.5 million worth of real estate. Now, here is where it really starts to get cool, is that because she owns $2.5 million in real estate and it goes up 4%, now she's making $100,000 of return in this case. So Sean,
In the same
yes,
time,
bought one in the same exact time,
with the same amount of money down.
same amount of money, bought it free and clear, and made 4%, just like any other investment. Bought it $500,000 worth of mutual funds, $500,000 worth of real estate, $500,000 worth of stocks. It doesn't really matter. You just get a return on whatever the market gives you on all the money you put in. In this case, Karen is leveraging her money. She's using the bank's money to make money, and she's able to buy 5 houses, $2.5 million worth of real estate, and now she's making $100,000 in that year, where Sean is only making 20.
With the same money down. You have to leverage, you have to get a mortgage, you have to go to the bank, you have to qualify, yes. But it's the same cash down, and now Karen has gone from, putting her 100K down, she's doubled her money in a year, whereas Sean has, made 4% ROI, which is okay, and that's good, and that beats a lot of, stocks out there and mutual funds. But which one? So just for fun's sake, especially our Igniteds, who do you think is smarter? Would it be Karen or would it be Sean?
Mm-hmm.
Who's smarter?
Who would you invest with if they brought
Karen
this concept to
or
you?
Sean?
Yes. Okay. Good. Awesome.
I hope he's watching. I really hope he's watching.
All right. So let me have. Do we have any questions in the comments at all?
Yeah, we do have a couple questions.
Okay.
You've covered. You've already gone through some of them. Some of them are a little bit longer, so I didn't actually get to read them. But one of the questions is, what about the cost of borrowing?
Cost of borrowing. Okay. All right. So guys, here's the key, and this is
Here's
the
the
cool
beauty.
part. This is what I really like about this. If we compare Sean and Karen's investments, okay? So let's compare. Let's say that this house, all 6 of these houses are gonna rent for the same amount, okay? They're in the same neighborhood. They're gonna go up the same value. We're comparing apples to apples here, okay? So in this case, Sean bought it free and clear, 500K, has no mortgage. So our initial thought is, well, he's gonna cash flow way better because he doesn't have the mortgage, right? Okay. So what does he still have to pay though? He still has to pay property taxes, he has to pay insurance, repairs and maintenance, vacancy allowance, all of those sorts of things, okay? So if we're being conservative and giving property management, if we're being conservative in some of those numbers, and remember he's giving $3,000, hopefully you guys can see that, $3,000 per month in rent. You take off those expenses I just talked about, property management, repairs and maintenance, vacancy, and we take off taxes and insurance. That all totals, let's say, roughly about $825. So I did the math on this earlier just to compare apples and apples, okay? So in this case, Sean is going to cash flow $2,175 per month, okay?
Just so you know, everyone's voting Karen.
Voting Karen, awesome.
Karen is smarter than Sean, right?
Okay,
Yes.
you guys are clearly catching on quickly, so that's really good. Okay.
Trevor says, I know them both. I know the answer to this.
That's awesome. You know what? When I first started doing the math on this, when I first started thinking, okay, but Sean doesn't have a mortgage, okay, so maybe Sean's right. And then I did the numbers, guys, okay, so bear with me here. Sean's going to cash flow $2,175 a month, assuming the regular expenses. Now, if we assume the same expenses for Karen, okay, Karen in this house here, because now she has a $1,700 and
different color
some
for
dollar
cash
a
flow?
month. Sure.
Should we do a different
Let's do
color
a different
for cash
color.
flow?
Hopefully they can see it.
I think so.
Okay.
So this should be
this
21.
work? Yeah.
Can you want to do 21.75 there?
2175. Let us know if you guys can't see that, okay? So Karen is cash flowing. Now, we have to remove the mortgage payment from that, and the mortgage payment in that case is roughly $1,700 for a $400,000 mortgage at 3.19%. With a 25-year amortization. Okay, a regular mortgage. In fact, a lot of you guys can get a lower percentage rate than that nowadays, but let's be a little conservative. She's going to, in this case, cash flow after the mortgage is also paid $450 on this house, okay, per month.
On that house
On
number
that
one.
house. Now remember,
in the first year.
Now remember, same with Sean, in the first year. So remember, Karen has 5 of these. Okay, so $450 a month, and this is the part that we sometimes forget. $450 a month times 5 months is actually $2,250 per month.
That's not in the picture on my phone. Sorry. No, you got to go higher.
$2,250 per month in cash flow. Okay, let's make that really important here, guys. $2,175 for Sean because he doesn't have a mortgage. Only $450 a house for Karen because she has mortgages. But when you get those 5 houses together, she's cash flowing more money a month using the same property taxes, the same insurance, the same property management, repairs and maintenance, and vacancy allowances. The only difference is she has mortgages to pay.
Now,
She's actually cash flowing more. Now, there's more to this. Okay, that's just the start. This is why it's so exciting, guys. And I hope that you guys start remembering this and be able to explain this to others and listen to this over and over again because it's really exciting, okay? So that answers the question. First of all, if any of you thought, well, he doesn't have a mortgage and she has mortgages, so he's doing better.
He's going to cash flow better, right?
No, Karen is doing better cash flow wise. Now remember.
Okay. Should I just interject with lifestyle?
Sure.
So let's remember, Karen's working harder for this money, for sure, right? She's having to, manage 5 tenants instead of 1. She's got 5 roofs, 5 furnaces instead of 1. So she is working harder for it, absolutely. Is she, making more money in her return on investment? She's made $100K this year, where Sean has made 20K. And they're cash flowing about the same, let's say. So she's working harder for it. But that's in the first year. Remember, the cost of borrowing goes down as time goes on. As our mortgages get paid off, the cost of borrowing goes down.
You just touched on the next point.
Sorry.
And that's a big point. No, that's okay. Can I get another color?
Red.
Do we have another color?
Red is negative, but it shows up best.
Okay,
I
let's
feel
use
like
red.
red is negative, but
well, we're going to talk about a mortgage, so let's use red, okay? So
right.
here's the dealio, all right? So Sean didn't have a mortgage, remember, okay? So he's getting $2,175 a month into his pocket. Good for Sean. Karen is getting $2,250 in her market, or per month into her pocket. Good for Karen. But what else is Karen getting? Out of those expenses, Karen is getting her tenants, because she's paying a mortgage payment every month, her tenants are also paying down a mortgage for her, okay? So if you look at any mortgage calculator, a $400,000 mortgage, 3.2%, 25-year amortization, $9,000 is paid off in the first year. So Karen also gets, so let's say $2,250 per month times 12 months. Go back to the cash flow.
Move this out a little.
Okay, just check the camera to make sure it's still okay.
Yeah.
She's making $27,000 a year in cash flow. Can you see the bottom here?
I'm just going to turn it this way. I believe now we've got a better picture.
Okay. And in this case, Sean, $2,175 times 12 equals $26,100 in cash flow, okay? So more for Karen than for Sean. But now Karen also has $9,000 per property, okay? per property times 5 properties equals $45,000 in mortgage pay down. I don't know if you guys can see that on the board, but that's an important number. $45,000 in mortgage pay down that Sean does not get because he doesn't have mortgages on it. Yes, he's getting cash flow in his pocket on that one property, but Karen is also getting her mortgages paid down and cash flow in her pocket. So way better. Plus she has 5 properties going up in value. So she has her 100K plus her 27K plus her 45,000K. She's got a total of $172,000. Okay, let's make this number big. $172,000 of profit in her first year, assuming the same numbers as Sean here is getting his 20K plus his 26, he's getting $46,000. Okay? Do you see a difference, guys, in these two numbers? This is the power of leverage. When somebody says to you, well, what about the mortgage? This is what you show them. You show them real numbers. Now, if somebody has $500,000 to invest with you and you say, listen, I'm going to put that in 5 houses instead of 1, and this is why, what do they start to think? This person kind of knows what they're talking about. I never thought of that before. I'm going to trust my money with this person. Okay?
So when you teach and when you become an expert in what you're doing, people start to realize that you know what you're doing and they have confidence in your credibility and in giving you their money to invest. So we've had a couple of other questions.
Okay.
So one of them was, does anyone have that 500,000 again to start? No, not necessarily. But for those of you that don't know us, we're Corey and Tiffany Young. We started, building our portfolio back 18 years ago. We had no money. And so we partnered with other people that did have money. So did we have 500 grand? No. But did we go out and meet and talk to people and explain and educate them on things like this? And did they give us that 100 grand to go buy that house? Absolutely. So we were able to do that over 100 times with partners. Again, we had zero money. We were able to do that over 100 times and buy over 100 houses. That all of these things, the mortgage pay down, the cash flow, the ROI, all of those things kicked in for us as working partners. They gave us the money, we did the work.
And so what we do now, guys, is we teach you how to explain this. And if you can explain it simply and without complication, and if you can show how the numbers vary, and if you can answer somebody when they say, oh, well, what about the mortgage? And you can show them this.
And what about the cash flow?
And what about the cash flow? And you can show them this.
Let me tell you something. For those of you that know me, I am not a numbers person. I know we have quite a few new people in Fearless right now, so this might be your first training with us this week, so welcome for one. But for two, welcome also to the fact that I'm not a numbers person. But I can tell you that I did, through practice, and I mean practice, sitting down, pretending I was talking to someone. There was no one on the other side of the table from me, but pretending I was talking to someone and going through and, drawing this out and explaining it and thinking of all the questions that they're going to ask me. I was able to explain this to them multiple times over and over again. And that moment where people go, wow, that's pretty cool. That's when you know that you've got some major interest and you have the ability to help them to get more out of their money than they're going to be able to get in mutuals or stocks or Forex or Bitcoin or any of that other stuff on a consistent basis. So it's this kind of stuff. Now, does this get complicated? Yeah, it can get complicated. Are we trying to rush through it in a half hour? Absolutely. Do you have to sit down and explain every bit of this? No, because your typical person isn't going to have all of those questions at their fingertips or at the tip of their brain immediately, like we have, 100 people, 91 people sitting here on with us, so people are asking questions like this, right? You're not going to get all these questions at once, but when you go over it and practice it as if you are, you'll be amazed how, drawing these pictures and all this stuff, it actually comes out to really being helpful in establishing you as that expert.
And very, very helpful to actually work this out on a piece of paper for yourself, okay? You're seeing this today. We're showing it on a whiteboard today. But throw this on a piece of paper yourself. Run the numbers. Use a mortgage calculator. Figure out what the property taxes on a 500K would be. Figure out all of these numbers. What kind of properties out there? I mean, there's a lot of variables here, guys, in this example. For one, you find a $500,000 property that's going to have to rent for $3,000 a month. Can you find those in your area that you're investing in? And if not, can you find another area to invest in? There's a lot of variables in this, but the point of this, guys, and I don't want you to get stuck too much on individual numbers in this example. I want you to understand the concept of leverage, the concept of using other people's money or using the bank's money to invest. And that's the power of real estate versus any other type of investment out there.
Yeah.
Is there's nobody else that's going to give you a mortgage to invest in something else other than mortgage.
There's no one that's going to give
real estate.
80% of their money. A bank is not going to give you 80% of their money to go and invest in stocks and allow you to put 20% down. That's just not how it works. If you want to buy 100% worth of stocks, it's 100% your money or a line of credit or whatever. But it's not going to be leverage. They're not going to give you that minimal in for maximum results. So we do have a couple other questions. So one of them is Anne. So Anne asks, so does Karen get a commercial mortgage? She could get a commercial mortgage because it's 5 houses or more or 5 doors or more. So she could, but she could also get single family mortgages and that would work just fine, just the same. Remember, the point is there that the tenants are covering the mortgage and then some. So you're not doing this on a property that's not cash flowing. You're doing your homework. You're finding the right area, which again is in different trainings that we've had. You're finding, analyzing that property properly. You're making sure the tenants, what they pay you in rent is overly compensating for all of your expenses and then some. So you're cash flowing on these. So it doesn't really matter what kind of mortgage you get. It's just that you do have, indeed, you're using some of the bank's money, but yet getting returns on the whole amount. Another question for you.
So look for the questions. I just wanted to add in here what the return on investment is, okay? Because, we talked about the number amount, 46,000 for Sean in this scenario and 172 for Karen. Now, remember, Karen, they both have the same amount of money in. So earning 46,000 on a $500,000 investment gives you a 9.2% ROI, okay? Hopefully that's clear enough, 9.2% ROI. Now, not a bad return on investment. A lot of people will take 9 or 10% return on their investment. But in this same scenario where Karen is making 172K because she has the mortgage pay down, she has higher cash flow, she also has a higher amount because she bought more real estate, so she has a higher lift in equity. She is actually making, any guesses? 34.4% ROI. So a 34% return or a 9% return.
This is in 1 year, remember.
And that's just the first year of owning this property, assuming these conditions that we've talked about. So that's the whole concept, guys, that we wanted to share with you today. Just the concept of leveraging yourself and the power of it in real estate. And if you can explain that clearly to somebody, then there's a lot of people out there, and believe me when I say this, there's a lot of people out there that will now invest with you because, why? Because you can explain this clearly, because you can show them that they can make a better return. You're their vehicle can qualify for these mortgages for you.
So that's one of the questions that we had was, so how does Karen qualify for all 5 of these mortgages?
Good question, yes. Now, some people can qualify for 5 mortgages on their own,
but most
especially
of us
some people who might have $500,000 in their pocket.
Right.
But if you're not one of those people, and a lot of us, then we don't have that sitting around, right? So what do we do now? We go out and find people that can qualify for these mortgages and can put these down payments down, and we partner with them.
So this one might be owned by Melanie. This one might be owned by Stacy. This one might be owned by Danuja. And they've qualified. So Robert, for your question, Melanie has qualified on this one and put down the 100K. Stacy's qualified on this one and put down the 100K. Danuja on that one and put down. So we're not having to go out and qualify on all these mortgages, nor are we having to come up with the cash for it. Again, we were 24 years old. We couldn't do either of those two things. Yet we were able to buy over 100 properties by finding people who were able to, that didn't have the time to manage properties, didn't have the expertise or the education to understand this kind of stuff. But when you're able to explain it to them and they go, holy crap, you can actually do more with my money than I can, I'll invest with that. Not only that, because they're qualifying on the mortgage, title's in their name. So they
have the
own the
security,
house.
right?
They have the security that is secured against land, and people really like that. So Robert, in answer to your question, how did Karen qualify on all those mortgages? She didn't. Her partners did. Does that mean that she's splitting? Because it's a 50-50 split usually. So she's giving them half the cash flow and giving them half the, annual return, not on an annual basis, but when they sell, they'll get half of all the equity they've made. So she's, getting half of that, let's say, if she doesn't have this. But if she doesn't have it, getting half of all this is better than getting none of it. So in our case, that's what we had to do.
In that case, when you're getting half of 34% return, your JV partner is still getting 17% return. And remember, guys, they're getting that based on the number they put in. But what are you getting? You, as the working partner in that scenario, are getting an infinite return because you're not putting any money in this scenario. Okay? You have a partner that's qualifying for the mortgage. You have a partner that's putting the down payment, and you're doing all the work. And that's the whole concept of joint venture.
I'm just going to put Barb's name in here right there.
Barb, okay.
There we go. One is owned by Barb. Okay, so Chantal has a question. Do we have time for a question?
Yeah, of course.
Okay.
I think.
Yeah, we do. If you had an opportunity to purchase a property with seller financing with 20% down, would you go this road alone without a JV partner and then borrow the down payment 20% from a private lender if the numbers worked? At the end of the day, if the numbers work.
If the numbers worked, absolutely.
If the numbers work. But you would be really careful to make sure that you analyze it really closely to make sure those numbers do work. Make sure your rents that you're getting from the market are tried and true. Get out there and make sure you know what that property is actually going to rent for. Make sure you know that you're going to get a certain rate on your mortgage. All those kinds of things. Make sure to put in a vacancy allowance. So, is the area normally, 5% vacancy?
Yeah.
Maintenance allowance, all those things. So make sure to count in all. And if the numbers work.
And here's the key in that scenario, what's her name? Chantal. If you have seller financing in that case, and they're pretty much doing 80% of the financing, I would still bring in a joint venture partner on that scenario, because here's the key. The key is for a joint venture partner now, they don't have to worry about qualifying for the mortgage. All they need to do is bring the money down if the seller is providing that. So there's a lot of people out there that have money to invest, but for one reason or another can't qualify for another mortgage. And so you're now broadening the amount of potential JV partners that you could market yourself to. And I would bring one of those in that particular scenario. The numbers might be a little bit less in that scenario, but still a win for a potential partner.
Everyone's like, yay, this is exciting. Okay, so guys, tell me, who thought going into this scenario that by putting $500K on this same house, by Sean putting $500K down, paying it off, who thought that there was going to be more cash flow than Karen going out and getting mortgages and putting only 20% down? Who thought that there was going to be more cash flow on Sean's side of things than by doing it with leverage, with debt, with something that to me when I came into real estate was a no-no. I didn't believe in credit card debt. I didn't believe in overdrafts. I didn't believe in any of that. It was like if I didn't have the cash for it, and I didn't have any cash, but I certainly didn't have debt because that freaked me right out. Who thought that this was going to be the winner? Sean was going to be the winner when really Sean ended up being the major loser. Like, the big loser was Sean, and the major winner. I don't even think they're on. This is such a waste. But who thought that it was going to be the other way?
I'm not talking about anyone in particular. These are just the names that came to mind.
Oh, you didn't plan it that way.
No.
I see.
No one in particular. I was just thinking they're good names for this scenario. So.
Yeah. Yeah, see, everyone's saying, I thought that Sean was going to come out the winner. But now, when you break down the numbers, and that's why analyzing the numbers in anything
and I'll be honest,
is so important.
I'll be honest, I didn't know the answer to this when I started this morning. Okay?
Just to the cash flow part, you mean?
Yeah.
To the leverage you
to
get.
the cash flow part.
Just to the cash flow.
I thought that Sean would out cash flow Karen by 1,000,000 to 1. But when we start looking at these numbers and we realize that there's just not one house. Okay, yeah, so one house, Sean cash flows
Sean
more
did.
than Karen's one house. But remember, Karen's buying 5 of them. So you put that together and now she's cash flowing more. I'm like, absolutely. There's no question we can see the power of leverage in this scenario. And so hopefully that makes sense for you guys. Hopefully that clarifies a few things.
If you have any other questions, we've got about 5 minutes left before we hop into Ignited. So certainly put your questions in. If we get them to you, or if we don't get them to you right away and you're watching on the replay, we know that this is a little bit of a deeper Tuesday training. So make sure to put them in, tag us in it, and we'll make sure to answer your questions for you. So couple of announcements, guys.
Yes, this leads into something. Okay,
Oh,
go ahead.
does it?
Well, kind of. Yeah, go ahead.
Okay.
Go.
Well, I was
your
just gonna
announcement
say-
first. There's a big announcement coming, guys. Okay, you go first.
I was just going to say that one of the PDFs that we're putting together for our boot camp this coming September is going to be a PDF that actually outlines this, so that it makes it a lot simpler. It's one that we used to draw out for all of our partners in our presentations that we did, but our Ignited folks we're working on it for them right now. So it's a PDF that anyone that registers for our boot camp, which is the big announcement,
Yes.
really, is boot camp. We finally have dates for it, and
We
we have
have
registration
dates.
is open. As of tonight, registration is open. So September 29th. So it's a 5-day boot camp. The same boot camp, guys, that all of you
The
guys
last
have
boot camp
loved.
we did one in August last year, we did one in October last year, and we did one in February this year. And if any of you guys have been to one of our boot camps before, you know the momentum that it creates. You know the changes that it can create in your life.
Yeah.
And we have so many examples of people that have just taken our 5-day boot camp and been able to propel themselves to find potential partners and to
Yeah.
find partners to invest with themselves in real estate. And so we are doing another boot camp, and we've waited since February to do this. It's on September 29th. It's Tuesday. It's 4 weeks from today. We're going to be starting at the same time, 7 p.m. Eastern, and we're going to be going about an hour to 2 hours Tuesday night, Wednesday night, Thursday night, Friday night. We're also going to be on Saturday, the following Monday, and the following Tuesday. And this is
Okay, so
all
5
focused towards finding money,
Finding money. Where do you find
freedom.
these partners? So people have been asking, so who's going to qualify on that mortgage? I can't.
Yes.
Who's going to put down that 500 grand? I can't. So how did we find those people? Where did we find them? How did we, what did we say? What kind of questions did we answer? All of that kind of stuff. So it's 5-day boot camp. We are charging for this boot camp, guys. It's the first time that we'll be charging for it. It's not very much money. Our Igniteds, of course, you guys come for free. But we are charging, it's $67 for the 5-day boot camp. There's homework every day. We're going to put you guys to work. We're going to get you some wins every single day so that you're actually progressing and starting down that journey. And the beauty of it is you actually get to see how that momentum starts being created, and you kind of be like, holy crap, like, I think I can actually maybe do this, kind of. You start to build that confidence in your mind because you start realizing and seeing it in your own life. So that's our 5-day boot camp. Early bird, we're early bird for the next 2 weeks.
2 weeks,
September
yep.
15th.
Yep.
I'm
2
always
weeks
wrong
from
on
today.
this kind of stuff.
Yep.
And Nins, as I said,
So early
August
bird, guys,
27th,
it's
September 29th.
$37 to join our boot camp. It's
Yeah.
not, we're not doing this
Boot
to make money.
camp.
I'll tell you
Yeah,
why
it's exciting,
we
right?
made a decision to charge for this boot camp. They've been free to this point. We made a decision to charge, and this is why. Because when you pay for something, you
pay
take it more
attention.
seriously. When you pay attention. And we want those that are going to be a part of this boot camp to take it seriously. We don't want you to be coming to this boot camp. It's called a boot camp for a reason.
There's work.
There's work involved.
it's good work.
This is to set your life on a different trajectory.
Yeah.
This is to give you new goals. This is to change your thinking. This is to help you figure out how you're going to start talking to people, how you're going to find partners, how you're going to be investing in real estate, making your plan going forward, making changes on your social media profiles. Guys, we go through all of this stuff in boot camp.
So-
it's 5 full days plus a couple bonus days. We're charging $37 for it. It's not a lot of money. That's
So
the early bird.
Nin put the thing in the feed.
Did she?
If
She
you guys
put-
want to
okay.
join, yep, you're welcome to. We actually have a couple of questions too.
Okay.
I love Nicole. You're like, you guys have so much
So
energy. I'm so excited.
I should just
I
say
get excited.
that if you want the early bird price of $37, click the link that Nin put in there. She'll put it in a couple
right.
more times, and you put in the discount code early bird. Okay, so if you just type in early bird, it doesn't matter caps, no caps, whatever. type in early bird, you will see the price change down to 37 from 67, and you're in. Okay, we're doing this in a private
Look at everyone
Facebook
saying-
group this
oh, right,
time.
right,
It'll be
right.
a little bit separate. It will
Right.
not be in Fearless. Every one of our boot camps before have been in Fearless. This one will be in a separate group that we're
Pop-up
creating
group, yeah.
just for this boot camp.
So
Okay.
we can really, 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 really focus
Yeah.
on just the boot campers for that 7 days. So yeah, do we register for Ignited? No, Marie, you'll get an
Yeah, all
invite
our
into the
Igniteds,
group.
you'll automatically
Yeah.
be put into the group. Anyone else, absolutely, just click the link, sign up, register,
put in
and all the
early bird?
information.
What's the coupon code?
Yeah, type early bird and you get the
Caps,
discount.
not caps?
Doesn't matter.
Doesn't matter. Okay.
Yeah.
Stanton says, how much is typically given to the investor that only qualifies for the mortgage? So no money down, only qualifying. So
Yeah.
you now have 2 other JV partners. What's the 3-way split? In
Okay,
general?
so Stanton, there's a million ways you could do that. Typically, if we were to say what
good
is the
starting
standard,
point.
25% for the money that's put in, 25% for the person that qualifies for the mortgage, 50% for the working partner. That would kind of be the standard. In a lot of cases, in almost every case that we've done, the JV partner puts the money in and qualifies for the mortgage, and they get 50. We're the working partner, we get 50.
Okay, but so that is a standard.
Yeah.
Okay, the 25, 25, 50. But in reality, I will say that a lot of times the working partner, so in our case it would be us, the working partner would give up a little bit more of a split so that each of the other partners would get more of a maybe like instead of 25%, maybe 30, 35, even up to 35% each. So you're kind of splitting it 3 ways, a little bit more fair. But as in everything with joint venture partners, what it comes down to is finding out what they need, what they're looking for, and then seeing if you can fill
Yeah.
that need by playing with the numbers, whether that's equity or cash flow or mortgage pay down. There's a lot of things you can play with in there. So
And really what we're talking about and what Bootcamp is focused on, guys, is having somebody else put in that 100K. Having somebody else qualify for those mortgages, because that's what Tiffany and I had to do. We did
had no
not
choice.
have the money.
Yeah.
We could
We
not
seriously
qualify
had no
for the
money.
mortgages. And so we had to go out there and find partners to do that. And our boot camp, what it's focused towards is to help you speak correctly, help you think correctly, and help you have these concepts strong in your mind so that you can go out there and you can start having these conversations.
I love it. And everyone's commenting. They're like, yeah, do boot camp. It was so fun. And changed my
That's awesome.
life, Mel says.
We
And
love
yeah,
it.
it's
To,
really
to
cool.
us, it's like
fun.
we've done
very
3 so far,
tiring,
and they've
but
been
very fun.
absolutely amazing. So we love it too. We're looking forward to it. Starts September 29th, so mark that on your calendars. Sign up now, guys, for the early bird if you're in.
Right on.
And the more the
a couple
merrier.
people said they're already in, which is awesome.
Awesome.
And it'll be a smaller group because we are asking for payment for it this time. But I think it'll be, a real strong group, and we're really looking forward to that. So it's not about the money; it's about getting that commitment. And so, anyways, thanks guys for joining us tonight. Hopefully this schmuzzle of drawing all over the
Yeah,
place.
it's not as neat as I thought it would be at the beginning, but
Oh,
hey,
I think it's so funny how you had to do 3D,
well,
like on these.
yeah, I was going to
Anyway.
continue on, but
No,
I
it
didn't.
was time. Yeah. Anyways, thanks guys. We'll see you next week. for
Okay,
Tuesday
thanks for
training.
joining us. Now I hope you understand the power of leverage. Practice explaining
Yeah.
this
Pretend
to your
you're talking to
kids, to your
someone.
spouse, to your mom and dad. Practice this because the more you practice it, the easier it will come out when you're talking to a potential investor. All right?
All right.
So
we'll see all
there
you
we
guys
go. We'll see you
over
next week.
In Laser, all our Igniteds. We'll
Yeah,
see you
we'll
guys
see
over
you
there.
Igniteds in Laser in just a few minutes. All right? Take care, guys.
Cheers, guys.
Okay. I'll go shut her off.
Oh, right.